Dynamic asset allocation. Dynamic asset allocation is an investment strategy that is dynamic with a rule-based asset allocation mechanism that intends to combine the unique benefits of equity and debt asset classes based on market valuation. Dynamic asset allocation strategy uses models to decide asset allocation, thereby removing human biases. It factors in market parameters before deciding asset allocation for the medium to long term. There are various parameters to build models. Compares earnings yields to nominal bond yields, helps determine the relative attractiveness of equities over bonds. Business cycle macroeconomic signals, attempts to find the current stage, are in the business cycle. Fundamental valuation signals, such as dividend yield, book market ratio, and PE ratio, to determine relative valuation. Yield gap is defined as the ratio of 10 years government securities yield, as a measure of long-term interest rates, to the Nifty earnings yield, as a measure of returns in equity markets. Relative attractiveness of equity versus fixed income is identified by studying the yield gap, and higher the earning potential of an asset class, higher the allocation towards it. When equity markets climb higher, dynamic asset allocation funds get busy booking profit and moving out of equities. The PE, or the price to book, in a rising market is constantly rising. At every increase, these funds are locking in profits and shifting allocation to debt. PE model considers the deviation range of the current PE from its long-term averages to decide the asset allocation across equity and debt. The first step in developing an overall dynamic asset allocation model is to forecast excess returns by constructing models that attempt to predict asset class returns using a set of explanatory variables or signals. Running tests over a sample period will help to reveal the strength of the signals and the overall explanatory power of a model. A good forecasting model must include economically meaningful signals, should not use data mining to fit in with the model, and finally, like the signals themselves, the decision process for determining what signals are included and how they are combined should be rational. The model followed to arrive at the optimal split between high-risk and low-risk assets varies across fund houses. Some use the trusty old PE ratio, some use variations of the PB ratio, and still others employ proprietary indices. The risk in dynamic asset allocation is that reallocation may be triggered before the upward movement in an asset class is over. The portfolio will lose to the extent that upside is still there in the market. The other risk in dynamic asset allocation is called whipsaw, where a mechanical rule triggers a set of transactions when the market is actually moving sideward. Investors exit and re-enter positions at almost the same prices when the movement in prices is not too significant, but a trigger has been set off. Such rebalancing can be costly due to transaction charges and taxes that may apply on rebalancing too frequently. As markets move up and valuations rise, their percentage allocation to stocks is systematically reduced, and vice versa without any emotions.